This episode is brought to you by Amazon Business. How can you free up your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams so they can focus on strategy and growth. Free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
Reality radio for a really great future. We're talking real money.
Hello again, and welcome to the radio show and the podcast that have been scientifically and specifically designed to help you become better at managing money. We call it Talking Real Money because we talk about the reality of money, not the myths and legends and the stupidity and the emotional biases we have. We want to put it in scientific, academically based perspective that is simple to follow. It's going to be a lot easier on you if you pay attention to what we're talking about as opposed to what most of Wall Street likes you to believe. Wall Street, and by the way, not just Wall Street, but all of the financial markets around the world. We're going to talk about the financial markets around the world today. I'm Don McDonald. I'm in Florida. Tom is briefly in Bellevue. Briefly. No, not Bellevue. You're in Duval. You're in Duval.
Yeah.
He's in Duval.
Please.
I forgot he's in Duval. He's by the lake.
Yeah.
Yeah, but he's getting ready to he's not going to be by the lake. He's going to be hopping the pond. Actually, you're not even going to be hopping the pond. You're going to be jumping the ice cap.
That's right. Yeah. Anything bad happens,
you're going right over the North Pole.
That's right. Yeah,
so if your plane loses lift, you're gonna be ice skating back.
Yeah. So let's hope that doesn't happen. What do you say?
Well, you'll be asleep.
It won't matter. It's over.
It'll be asleep. You'll be napping on the Ambien. Hi, everybody. We're here to talk about money. By the way, if you want to call us, our phone number is 855-935-TALK. That is 855-935-8255. We often discuss this crazy little thing about people called home bias. We root for the home team. And in the United States, our portfolios reflect that home bias. We have a larger percentage than we should of our investments in this country in United States stocks.
Way larger. It's about 85% of the most portfolios is in large U.S. stocks. They don't even have smaller value or the other stuff, but most of the money is
big U.S.
kind
stocks.
of in the S&P 500. So yes,
and depending on who you listen to, if you're looking at total stock valuation, not the index weighted like the indexes because they overweight, but if you're looking at total market capitalization, some say that the U.S. is about 50% of the global stock market. Others say it's about 65. That's the MSCI ACWI, which has
Go ahead, please say that a few more times.
Has a little bit of a bias to it.
All Country World Index shows, as of now, 64% of the value of stocks is inside the United States, 36% elsewhere.
Yeah, but that's really not total market cap because of the weighting of the indexes.
That's right. That's right. So
we're really very close to 50-50.
We're doing the best we can here.
But you'll notice that international funds in the U.S. balance their portfolios to about, some of them like the AVGE, the Avantis fund, are 70-30.
70% in the U.S., actually, a little shy of 30% international.
Yeah, which is not a good balance. Why do they do that, do you think?
Because they want people to buy their fund, right. And they think people are going to say, I'm in the United States. I know that country. I trust those companies. I'll put the money there.
Yeah. Now, let's look at Vanguard, shall we? Vanguard has an ETF that is only available to Australians. It's called the Vanguard Diversified High Growth Index ETF. Now, you'd think Diversified High Growth Index, and it's, by the way, it's a global fund.
Okay.
90% equities, 10% bonds.
Not a lot of balance, but okay.
Well, here's what I found really interesting about this portfolio. If you look at Vanguard's VT, it's about 60%
U.S.
60-40.
Yep.
Well, this portfolio, which is available to Australians, is 42%, no, not U.S., 42% Australian stocks.
Yeah, okay, but what if you go to Germany? What percent of
I don't
the
have a
Germans
German fund.
No, but if I'm telling you,
I mean,
'cause
Germans
the
are
last
almost
time I
all
saw
in
this,
bonds.
they are more conservative.
They're
We
more-
looked that
they
up.
are.
Not surprising. But if you look at their
this-
stock portfolio, most people have a home bias. They
What
do.
percentage of the global stock market is Australian companies?
I'll go with
Less
like
than
3.
2.
Okay, I knew it was a small number, but wow.
And yet, for Australians, pandering to Australians, the portfolio is 42. I mean, for heaven's sake, less than 30% is in the U.S. 855-935-TALK. That's our number.
Tom and Don are talking real money.
Why does the United States pay higher drug prices than other countries? Because America's the only country in the world where 340B hospitals mark up drug prices and PBM middlemen charge billions in hidden fees. Meanwhile, Americans subsidize the research and development for new cures. Other countries benefit, but don't pay their fair share. Crack down on the middlemen. End the free riding. Lower drug prices. Go to balancethescales.org to learn more. Paid for by Pharma.
Your guides to a really great financial future. Tom and Don are talking real money.
Home bias is a bad way to invest. And let me give you an example. If you were invested in the U.S., the bulk of your positions would be in the big tech companies.
The ones that have gone up the most recently.
And you'd have about 3,000 so stocks in the U.S. in most cases, maybe more. But in Australia, there are only 300 stocks in their index, the Australian Index Fund. And of those, about 25% of the portfolio is in banks. Totally different mix of assets.
Yeah, that's interesting. So, I mean, I would love to talk more about this and really dive into some of the other countries around the globe to see how they're invested. But
It's
I can
all
bet
going to
you
be the same.
it's going to be because, and you run into these by the way, just to close the book on all this, Dimensional's global portfolio, 71% U.S., about 29% international.
The
So you get another
only
bias
argument for that is the fact that they're pandering to customers. And I believe I asked this question once of one of the people, either at Dimensional or Avantis, and I don't remember which. And they said, yeah, we do it because that's what our customers want.
Yeah. I was in a study group with a bunch of other advisors who are way overweight U.S., and they said that's because that's what people want.
Are we supposed to give them what they want or what they need?
Exactly. So, but a couple things. Number one, make sure you have some commitment to international because I run into a lot of portfolios that don't. Make sure that commitment includes emerging markets, please, because they've been one of the best markets for the last 50 years. And number three, ignore recent returns because we got a note from a person named Micah in Orion, Illinois. Very nice comment about how way back when they used to listen to us and they changed their investing style. Great. But then they said, had I used global funds since 1992, I would have made less money.
Yep.
I would have made as much money as just being in the U.S.
Right.
I know.
Past performance is not indicative of future results.
Especially 30 years worth. I mean, I would be looking as long as I can. Going way back, 50 plus, you made more money being diversified and you actually reduced the volatility a little bit.
Okay, wait. That actually, it's less than a little bit. It's a decent amount.
It's a decent amount.
It's a decent amount, and that's the point. We are not just – if it's just greed, then give up on indexes and broad markets altogether.
Only buy the stocks that go up.
Picking all the good ones because you know what they are. But the fact of the matter is, yes, you would have made money, but there are also periods in there where you would have lost a lot more money if you hadn't had international. And it's those losing periods that scare people out of the market, and that's what we're trying to avoid, is you being frightened out of the market. International, broad global diversification will smooth the bumps up and down.
And we have an example of that not that long ago, the aughts, 2000 through 2009, where the U.S. market basically made nothing and international made, 5 or 6%?
No, actually, if you had a globally diversified portfolio like the IFA portfolios that we use sometimes, or the dimensional portfolio, the return was about 7% per year versus -1%.
That's not that long ago, folks, so pay attention.
855-935-8255. That is a very important phone number because every Saturday it allows you to call us and actually converse with us as opposed to just leaving a question and we answer it. And we're going to begin the call-in festivities in Gilbert, Arizona, where Donna resides. Donna, welcome to the show.
I've been a Tom and Don enthusiast for years now.
Thank you.
And
that's kind.
And I wanted to give a little backstory here. I've got a paid-for house, a good pension, a stream of dividend income from a cash account. At 73, I'll have significant RMD. And I know the importance of waiting until 70 to collect Social Security, yet for some reason, when I was two years after my full retirement age, which was April, I went ahead and applied for Social Security. Mm-hmm. I'm getting a check, I guess, next month. And I'm now I am basically doubting why I did that.
Well, yeah, we're only going to take credit for 5 out of the 6 of those, so you can keep 1. So, but thank you.
So you're wondering if you can get out of it? Is that what you're asking?
Well, I think there's a way you can suspend it. Yep. I found out I can suspend it
after up to 6 months, I think.
Yeah, you can do it up to 12 months. You can withdraw your claim up to, I believe it's up to 12 months after your first filing. What was that noise?
Well, the thing is they're making it kind of difficult now for some reason because it used to be easier to suspend it. Now it's kind of, you got to go through a lot of hoops, apparently.
Yeah, well, that's probably in part because of the fact that the staff at Social Security Administration has been reduced dramatically.
Yeah. So what I'm calling you guys for actually is to comfort me and say, keep it. You're all going to be okay no matter what, and it's not going to be that big of a deal.
You already know Don took his early.
I am 69. I'm going to be 69 in a few weeks. I just decided a few days. I just decided a couple of months ago. I went, you know what? I'd rather just start spending it now. It's not going to be that much difference between 69 and 70. So I did it. I did not follow my own advice. I admit it. I am a weak human being.
Don, I heard you mention that one of your previous episodes, and that's why I went ahead and did it.
Oh, look at that. Now you're costing Donna money, dude.
I got to tell you, I still got a daughter in college that I'm paying for, and I went, this is just going to help me with my expenses now, which are higher than they're going to be in 2 years. So I took it.
And then the Medicare is going to go up. I noticed, too. I have a penalty now with my Medicare payment because of my income level will be too high.
Irma, yeah, right, correct. But
the downside to it.
Yeah, didn't you say something about a paid-off house, a pension, a lot of other stuff?
I think you're in good shape, aren't you?
Yeah.
I'm in good shape. And I don't really even need it, so I just don't know. I had a weak moment there, and I'm going to go with it because
I am not going to Irma complain. I am not going to complain about having to pay taxes on my Social Security. I'm not going to complain about any of that because, you know what? We're comfortable. I mean, it's people who are really suffering for whom I feel badly if they have to pay big tax bills.
And but back to the Social Security question, Donna, is in your case, this is going to be at the margins. For most people, they have to be extremely careful with Social Security because it's going to be the majority of their retirement income. So under that case, if they're going to live the 10 years, remember, you got to live the 10 years after the time you take it or the formula doesn't work. They should wait every moment to take it. Don's not going to be in that spot. I'm not
because I'm not going to live that long.
Yeah. Well, I've already made that arrangement, but I'm not supposed to talk about it publicly.
Yeah, Tom's already worked that out. So I think
hoping you both have long lives. I'm not done with you guys yet.
You're not done with us. I'm not done with you guys yet. All right. Well, thanks, Donna.
Thank you.
Do whatever you feel best doing.
You're going to be in a good place. Yeah.
But the problem is, yes, it is a very difficult process to suspend.
Yeah. Harder and harder, I imagine. So it is up to 12 months later.
It's up to 12 months after, but you have to repay anything you've collected.
Yeah, you got to give the money back.
Got to give the money back.
Yeah, of course. Yeah. Well, they got to afford the parade. I mean, they got to, we got to chip in for that. You're not going to make it happen, right? So, it's a lot. Costs a lot to roll those tanks.
Tanks across America. It used to be hands across America. Now it's tanks across America.
I asked the guys here in the Modern Military Museum if we could have a flyby.
You have no guys in the model military aircraft.
You know what they
museum.
said? They said, it's Saturday. No, I'm not working Saturday because America doesn't even work Friday, much less Saturday. So forget it. Not going to happen. Sorry.
America doesn't work Thursday and Monday, too. Maybe we'll come in Tuesday and Wednesday if we're feeling good. All right, we have a line available, and your calls are always welcome at 855-935-TALK. Give us a call.
Tom and Don are talking real money.
You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
For your real life and real future, Tom and Don are talking real money.
You know, I'm still confused about that home bias thing. You know, it's like, is there a reason why a heavily Australian portfolio would be a better portfolio for someone living in Australia than one that is more heavy in the U.S.? No, there's no logical reason. Logical.
Okay,
logical.
Currency, the fact that you're invested more in those companies, so when you take the money out,
fluctuate that much.
Not that much.
They're not like Bitcoin.
You said, is there any? That's one. You could,
but
it's make that argument.
But they're by the way, their international portfolio is hedged.
No, then it doesn't work as well,
right.
does it?
Kind of eliminates that argument,
okay.
huh?
All right, so much.
So
for
is there a logical argument? No, it's all emotional.
Yeah, it is.
I'm an Australian, and I'm proud of being an Australian. So I want 42% of my portfolio in Australia, damn it. It makes no sense. Just like having 85% of your portfolio in the U.S. makes no financial sense. Thank you.
And beyond that, it could cost you a lot of money because look at Japan, 1990 through the end of last year. Basically, you made no money. And basically everybody in Japan holds Japanese stocks. So it could be costly.
Could be costly. Let's go to Texas. We're going to go deep in the heart of Texas, I think. We're going to go way down there, deep in
Houston?
the heart of Texas. I don't know how deep we're going because it just says Texas. Kyle, welcome to Talking Real Money.
Good afternoon, gentlemen. It's San Antonio, Texas.
San Antonio, that is deep in the heart of Texas.
I love San Antonio. That's where my dad retired at this end of his Air Force
remember the
career.
Alamo.
Oh, please. You're one of the few guys still alive who was there, so congratulations.
Yeah. Me and Bowie and Boone. Go ahead. I'm sorry.
Excellent. Well, you're fine. Thank you. It looks like I picked a good day to call. So my question today is I'm looking to set up a 72T out of my IRA and pull my money out of my IRA early. I'm 50, and right now I'm currently invested in AVGE and with about 85%, and the other 15% is AVUV.
Okay.
I like that small value tilt.
Okay.
When I split the money to do the 72T, I'm going to split it in half. And I'm supposed to start looking into bonds now because I'm taking money out. But I've been so against bonds my entire life that I'm having a hard time accepting bonds for what they are. And because if bonds are only to mitigate volatility, and I have no issues with volatility, why would I think about doing any other allocation other than sticking with AVGE for the money that I'm pulling it out?
Well, before we go to that question, which I'm going to give to Tom, you're just for everyone listening, a 72T is a rule in the IRS code that lets you take money out of your IRA before 59.5 without the penalty. And it requires that you take them out in what they call substantially equal periodic payments over the next
life expectancy.
Well, it's based on your life expectancy, but you have to continue it for 5 years or until you turn 59.5. Yeah. You still owe the regular income tax, but it just gets you out of the penalty. My first
10%.
question before we get to that is why are you 72T'ing if you're
At
a
50?
long-term investor?
Well, because I've had a medical event that is, it's not likely that it's not life threatening. So I'm still going to live a long time based on my genes, but my quality of life is going to pretty much slowly deteriorate. And the track that I was on retiring at 65, or that just kind of isn't there any longer. And I have enough money to retire. I've been an oversaver.
All right.
Okay. Well, we're sorry to hear about your health. That's a horrible thing.
Truly.
But very quickly, if let's just say for sake of argument, you had $1 million and it's all in stocks, and that goes to $500,000, and now you got to take that withdrawal. Mm-hmm. That's where the bonds come in, because they're going to give you something there to pull from rather than pulling more from stocks that have gone down substantially. Beyond the volatility aspect, which is something to consider as well.
Yeah, that is something to consider. And I did take your risk quiz, and I scored an 86 on your risk quiz.
That's very, very high. But again, because of your situation, it's really not even back to the risk quiz. We're getting into risk profile, risk need. You are to the point where, at least for some of that money, you really need to mitigate possible risk, because you're going to be hurting yourself if you're taking these big withdrawals and it's down 50%.
Tom and Don are talking real money.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold! Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
Finally, we're plunging into the Puget Sound area with a call to 855-935-TALK here on Talking Real Money in Sammamish. Jason, welcome to the show.
Good afternoon, gentlemen. Tesla Bull calling you back.
Hey, how's it going lately?
Been a while.
I don't want to.
It has been a while.
I shouldn't ask. I'm sorry.
He's got his car in a garage somewhere, undisclosed. I'm sure of that. So yeah, good for you.
In the Seattle area? Yeah, probably.
Yeah. My question is mostly for Tom today, because I know that you are more of the stock guy. So I know you're both against, owning single stocks for the most part, but I do believe they have a place in a balanced portfolio. Anyway, I have a number of Palantir shares, and I've been recently experimenting with covered calls, and I've been enjoying the premium. And I just want to know, to me, when we're talking about individual stocks, covered calls seem like one of the safer options. So I guess I want to hear you tell me why covered calls aren't a safe and effective way to add a little bit of money to your brokerage account.
Are you saying I'm more the stock guy because I'm going to give you a stock answer, or which is it?
Yeah. No, like I think as I understood it, you were more the stock trader of the two between you guys.
Oh no, he's definitely not.
No.
That would have been me.
You got to call more often.
That would have been me. When I was a young warthog. Back in the warthog brokerage business, I was actually for a very for a 20-something, a lengthy period of time, a covered call writer. And I was a successful covered call writer until the market got extremely volatile. Covered call writing works reasonably well in a flat market because you can...
Well, explain what it is first.
Covered call writing is buying a stock. Yep. You have to have at least 100 shares of the stock. And then you can sell someone else the short-term right to buy that stock at a price generally a little bit above where you purchased it. All right, which is so great if the stock doesn't move much. If you've got a $10 stock and you sell somebody an $11 call, you collect like $1 premium for that. So now if they take the stock away, you've made $12. I mean, made $2. You sold
But Don, here's the beauty.
Yeah.
If it keeps going, you just roll it into a higher call.
Yeah, but you're gonna be chase. You've got to close out the previous call, which has gone up in value, and depending on how far out the call is, it could have gone up precipitously in value. You have got to close that position before you can sell a new call at a higher strike. So therefore,
you've got to do it. Go ahead,
Jason. Let me just tell you.
Yep.
Back in the 80s, I did this, and the whole thing unraveled when the markets went crazy in like 87. Because the prices were, what was happening is you were losing stock, or you were riding in subsequent things at much lower prices, or you were holding a stock that you didn't necessarily want to hold anymore because it was crashing and it had looked great before, and now you're stuck with it. You either have to sell the stock because you're not in the money on you're not able to sell in the money premiums anymore. So
guys, can I bring this back like to earth now, just for the rest of us investors? Here's the thing. This is not my area of expertise by any stretch of the imagination.
No, it's not.
No, it's not. But I will say this. From areas of expertise I have seen in being in the business for 30 years, most people do things like this because they want to make more than the market. They figured out that it's not enough to get 8, 9, 10% a year. And most people end up with less. Again, this is my own experience seeing people do these kind of things than had they just bought the market and stuck with it.
And actually, the proof of that is in the returns of covered call writing funds.
That are out there, sure.
Yeah, and they don't outperform just buying and holding stocks.
Well, and I'm not opposed to holding. The stock that I'm doing this on is one that I want to own. It's Palantir, actually.
Yeah,
and
I know
we know them.
So my approach to it is like, I'm not letting the stock run too far ahead in the money. If I sense that it's getting high, I'm going to keep rolling it until I, have it expire worthless, and then I would go in the future and buy it again.
All right. Well, here's the thing, Jason. I wish you well because I am very confident that it will work right up until it doesn't. And when it stops, you're going to hate the strategy. 855-935-TALK.
Tom and Don are talking real money.
Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Your guides to a really great financial future. Tom and Don are talking real money.
But real quick, before we move past this, Palantir, for those of you wondering, is one of those meme stocks. It's a lot like GameStop or AMC, except Palantir is in a new kind of thing, but it's really an old thing. They're consulting with the government and creating technology that, by the way, other companies are trying to create to compete with them. Companies like, I don't know, Microsoft, Amazon, Google.
Fairly big kind of enterprise. Yeah.
Now, there are some aggressive companies, aggressive growth stocks out there that people are buying. NVIDIA. That's one. It's Apple. That's another. And they're trading. Apple's PE is about 35 times 2025 earnings, roughly. NVIDIA is about 46 times 2025.
Don't even tell me Palantir.
Now, Palantir has earnings. They do have positive earnings. What is their price earnings multiple or PE ratio?
It's something ridiculous. It's like 200 or something, right?
It's like 1,058.
Yeah. Okay.
There, it is trading for over 1,000 times its 2025 earnings per share.
Talk about being perfect into the future to maintain a price.
And in an area where it is so easy to compete. And by the way, their clients are basically only the big clients, only the government. Gee, what's the government doing right now in terms of money?
Something about cutting something, reducing things. I don't know.
Cutting, Other
than the parade, of course.
I got to tell you, Jason, get off Reddit. Just get off that. It sounds like he's on it. Between Tesla and that, you're on Reddit.
Yeah.
855-935-TALK is our phone number. That's 855-935-8255. And now we go to Ohio. Oh, it's John from last week calling back about Fidelity fees. Hi, John. Hey, John.
Hey, Don and Tom. How you doing?
Good.
Very well, sir. Yeah. How can we help?
Hey, can you hear me?
Yep, we hear you well.
I'm calling you back about the Fidelity. Yeah, I called my rep on Monday morning, as you suggested, and left him a message. Called me back 2 hours later. That was pretty good, I thought. So I told him, hey, what's up with these management fees, like on my statements?
Yeah. Let's set the table again here so people understand.
John, hang on. Let's reset for listeners who are just joining us and are not familiar with last week's show.
Because it was a little confusing. You were paying them a management fee, but it was all over the place. Like 1 month was a certain amount, 1 month was way more, correct? Isn't it something like that?
Yeah, like on my monthly statement, it was showing up, and I don't think I'm actually paying those fees, but 1 month on the monthly statement, it would say Fidelity management fee, $2,800. The next month, it would say $1,800.
Right.
The next month, it might say $1,100.
So what did he say? What did the advisor tell you?
High in the first place.
That sounds high.
Well, like I asked him what's going up, and he says, I don't see any of those numbers on my screen. And I go, well, are you looking at the monthly statement? He goes, well, I can't see the monthly statement. I only can see the master file. And so he said, if you want to come in with your statement, you can, but you are scheduled to come in next month. So I'm going to do that, but he did say, based on his information, that I'm paying like 0.96 for my management fee, which is about what I thought I was paying. But he couldn't tell me why those numbers were showing up on my statement,
It seems
I guess I'll
strange
find
that
out
he
when I
couldn't
go in
find
and
a
talk to him and
statement,
he
but...
sees it.
But I'll tell you what, John.
Yeah.
After you have that meeting, give us a call back and let us know what he says. But do take all of your statements with you down to the office so that he can see exactly what you're seeing, and make sure that if you're at all confused, that you have him write down the answer. Okay.
Okay, but let's just couple things. 0.96 on an annualized fee is reasonable. That's not outrageous.
Right.
The variation of those fees is, but here's what I'm worried about, John. Is it possible the money's just custodianed at Fidelity, but somebody else is actually managing it, another firm that keeps the money at Fidelity?
There's a fee of 0.96 at Fidelity. And
he
he's
may
his
be able to see
advisor,
that
and
anyway.
he's meeting with him as his advisor.
That's a good point.
So it's his advisor. So, again, I come back to my suggestion is make sure you take all the statements you can find with you. Make sure you highlight the fees you're concerned about. And if there is any confusion whatsoever, if it's kind of talking circles around it, have him write down his response. And then next month, we'll be here next month. Tom will not be on vacation, I think, yet again. So call us back and we'll go through it, okay? Thanks so much, John. We appreciate you calling back.
Good luck to you. Yes, sir.
Okay.
All right, sir.
Thanks.
Take care.
Happy birthday, Don.
Oh, thank you. Take care. 855-935-TALK.
Did he say happy birthday?
He said happy birthday to me.
It's not your birthday yet.
It isn't yet. No, it's in a couple weeks.
That's 10 days away or something.
Well, but he's not calling back till next month, so he's going to miss it.
What do you want for your birthday this year?
I want nothing except not to have another birthday.
I want to celebrate birthday in my way, not your way.
I just want to skip it. It's like, what's coming up this weekend? We have one of those fake holidays this weekend.
Flag Day?
Father's Day.
Oh, Father's Day.
Another stupid holiday. I hate Father's Day.
Wait, I've got a quote for you for Father's Day. Is that okay? I love this quote.
Okay. I bet
it's from a book somebody gave me a number of years ago. Yeah, I think it is kind of funny.
Right.
This is from Mark Twain. far funnier guy than me.
Oh,
he
Samuel
said,
Clemens.
when I was a boy of 14, my father was so ignorant I could hardly stand to have the old man around. But when I got to be 21, I was astonished at how much he had learned in just 7 years.
Okay,
that's funny.
Thanks for the quote. Let's go to South Carolina now. And Elizabeth, welcome to the show. Hi, Elizabeth.
Hello, Donald. Hello, Thomas. Thanks for taking the call.
Pleasure.
My pleasure.
My question is, what happens to a target date fund after it hits the target date?
That's a great question. You know what? It just keeps going.
Yeah.
It just keeps going because they never
that's a good question. What if you're in a target date 2010 fund? How much? What's the stock to bond? Does it keep adjusting to lower stock exposure? Probably.
Yeah. No, I believe they do. I want to pull up. Let's see if I can find a 2010.
Vanguard's 2010. I could do that.
You can't either.
Yes, I can.
Are you that good at this?
Anything you can do, I can do better. So,
I don't think so.
Okay. But no, I believe they continue to adjust the. You're making us race here on the.
Yeah, because we have a target retirement. You're slower than I am.
That goes without saying. Let's see. The 2010. I'm looking at Vanguard's right now.
I'm trying
the 2010.
to find it.
Yeah, it it didn't come up. VTENX, the Vanguard Target Date 2010 Fund. And how is it invested? It is, where is it?
I'm just going to let you look it up. What was the symbol?
I'm trying to find VTENX. Because let's see, so that might have been retired 15 years ago, so you should be, I don't know, 80 years old.
It doesn't show up. So maybe it just
Vanguard
goes away.
Page here.
You know what? I'm going to find out.
Give you your money back. We'll talk about it.
I'm going to find out while we have more time. I got a whole minute here to do that. So hang on. We'll be right back. 855-935-TALK is our phone number. Call us every Saturday.
Tom and Don are talking real money.
At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can finish the bachelor's degree you started in 19 months and under $19,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by PACE, transfer credits, and other factors. Fees apply.
For your real life and real future, Tom and Don are talking real money.
I figured out what Vanguard does.
I found the 2020, but I haven't
you're
found
not
the
going to find
2010.
it because what they do when they are that old is at
please
in 2017 they took the Vanguard Target Retirement 2010 Fund and did a tax-free merge into the Vanguard Target Retirement Income Fund, which is the most conservative their portfolios get.
And how much is that? What's the stock to bond ratio on that? Because it's got to be 40-60.
No, lower than that. I bet.
Really, 30% in stock, 70% in bonds.
VTINX is.
I saw that one. Yeah,
that's as conservative as they get, and it's 70-30.
70% in fixed income.
Fixed income, 30% stocks.
30% in stocks.
So 30-70 actually reverse.
30-70, yeah.
30-70.
Okay. So there
and
you go.
that's where they stop growing more conservative. So when your fund, if you have a 2020 fund, then in about 2027, they will merge that into the VTINX, giving you their most conservative suggested portfolio.
That's pretty conservative. I mean, that's, that you hope for a little ahead of inflation with something that has that little stock exposure.
Well, yeah, a little
1%,
exactly.
2% maybe above. Yeah.
Let's see what its performance has actually been. So, yeah, you're right. 15-year average annual return for that fund is 5%.
There you go.
Per year.
Yeah.
And so that's a little better than you'd expect with bonds, or you would have gotten with bonds. A little bit over that period. That was low interest rate. That's a low interest rate period because
you're not going to get much in bonds then.
If you look,
I bet the bond portfolio is more like 2% for that period of time, maybe 2.5%.
Yeah, but if you add in the 3, though, again, you're right close to inflation. So right at the 5. So
anyway, that's a really good question, Elizabeth.
Yeah,
so
the,
yes,
the 15-year return for BND was 2.25. So 3% over.
I hate it when I'm right every time.
I do
It gets
too.
so old. You're going to be so glad to see me wing off, getting out of here, leave you alone for a couple of days.
For a couple of weeks.
You know I'm calling you. You know I'm calling you from there. So.
No, you're not.
Yeah.
No.
Count on it.
No,
because we're now closer in time than we would be from here to there, probably.
Yeah, but it's not going to work in your favor.
I know.
Because you'll
have to get
really
up
ridiculously early, and I'm not getting up. No way. You call me when it's like 6:30 a.m. your time.
Okay.
It'll be 1 in the morning. No.
Okay.
Do not call me.
Sorry. I'm going to miss you, though.
Oh.
Right.
I think we
I got to call you on your birthday for sure.
We could stand 2 whole weeks apart.
No way, man.
All right. I'm going to Disney Vacation Club on my birthday. We're just going to sneak out for a couple of nights. It's not much, but it's, I can hang out by a pool. You're not here, so I don't have to work as hard. Hey, I've got something to share with you.
Please.
Hey. Even though Tom's going to be gone, there are other advisors at Apello Wealth who can help you.
Really?
Yeah, who can help you. If you got portfolio issues, plan issues, you just want to kind of find out where you are and where you might be going, and you don't really feel like you need to hire anybody at this point, well, you're not going to be pressured into doing that. If you ask one of our advisors for help, it's free, it's easy, and there's no high-pressure sales pitch. Just go to talkingrealmoney.com. That's our website for the show, where you'll find a lot of other cool stuff, too, even the ability to ask us questions. But if you go to the very top of the page, and you'll see a Meet an Advisor button. You click on that, and then you just set up an appointment to meet with an advisor right there at talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apello Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apello Wealth, a fee-only registered investment advisor. Please see Apello Wealth's ADV Part 2A on our website for information regarding Apello's fees and services. Apello Capital, LLC, DBA Apello Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apello does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.